Investors Chronicle.
Companies and Market Show on the pod today. Compass is our result of the week. Mark Robinson will be talking rubbish, or rather talking us through his feature on waste management. And the IC Funds editor, Dave Baxter, joins the pod for the first time. Companies and Market Show, welcome back, listener. It is Thursday, the 12th of May now, as we record. And delighted to welcome a first-timer to the podcast, Dave Baxter. Hi, Dave.
Hiya, thanks for having me.
Good to have you. Listeners will be familiar. Done a few IC interviews as well, haven't you? So a veteran of the microphone.
Hope so.
Great to have you. Great to have you with us. We've also got Mark Robinson back this week. Hi, Mark.
Hi, John. You okay?
Good, thank you. And Julian Hofmann as well. Hi, Julian.
Hello there, John. Okay.
Hiya. And of course, we've got Dan Jones, who's going to be taking us through our discussion topics a little later. But before we get onto that, a quick news roundup from the week that's been. Rising rates and recession fears are continuing to impact world markets. In particular, there's been a big sell-off in US tech. The Nasdaq, for instance, down 28% year to date. Even Apple is not immune and is now no longer the world's most valuable company after shares fell 5% yesterday. Aramco, the Saudi Arabian oil company, has taken top spot. A couple of potential mergers to report. Capital and Counties and Shaftesbury, two of the West End's biggest landlords, are in talks, while real estate investment trusts LXI and Secure Income have reached an agreement, forming a $3.9 billion property portfolio. A few other selected company lines from the week. The Ukrainian-based iron ore miner Ferrexpo has defied expectations in announcing a final 2021 dividend. The miner has managed to keep producing and exporting to Europe despite the ongoing warfare. Revenue at ITV has shown signs of growth in the first quarter of 2022, but things are expected to get bumpier as the year progresses. Total streaming hours, a key performance indicator, fell by 7%. Meanwhile, BT has spun off BT Sport into a joint venture with Warner Bros. Discovery in a move which will bring together BT Sport and Eurosport. This allows BT to push on with investment in its fibre optic network Openreach and its 5G service. Hargreaves Lansdown shares tumbled 7% when markets opened on Thursday morning. It came as the investment platform reported assets under management fell to £132.3 billion at the end of April. That's down from £141.2 billion at the end of last year. And salmonella found in Cranswick's Hull facility saw shares in the food producer fall by 5%. All these company updates and more are available in more detail on the Investors Chronicle website. Just seek out the Today's Markets articles in our company's news section. And a reminder to subscribe to our trader newsletter to get the latest news straight into your inbox every weekday. Link in the podcast description to that. Finally, from me, Tesco chair John Allen has joined the chorus of calls for a windfall tax on energy companies. In comments made to the BBC, Allen said there was an overwhelming case to help mitigate the cost of living crisis for those most in need. All from me. Over to Dan to kick us off with our result of the week.
Hi, John. Yeah, we're going to start in what's been obviously quite a difficult week for many investors. We're going to start with a bit of good news. Compass Group is our result of the week. A company that had a pretty tough pandemic for a number of reasons. I think there was the rights issue a couple of years ago, 2 years this month, in fact. And, some negative publicity as well when one of its subsidiaries was collared for producing some rather underwhelming food boxes for children, I think, during the pandemic as well. But, time moves on, and this week we've seen guidance raised, we've seen a buyback, the dividend was already restored at the end of last year, and obviously investors reacted pretty well to that. Mark, you covered the results for us for the IC. Is it all good news? What's your sort of take on Compass's fortunes?
It's never all good news, Dan, as you know. In terms of the latest interim figures, as you say, the market responded well. I think they're up about 10% in early trading before trailing off a little bit later in the day. And in addition to the bringing back the interim dividend, I think they'd paid a full year one. But in addition to bringing that back, they announced a a £500 million buyback, which is to be completed or at least initiated by the end of the year. There was various metrics that management was keen to highlight. One of them was the highest ever retention rate, which is great, but it needs to be seen in a wider context there as well, because I mean, obviously they're coming from a much lower base, and you could even say that about the new business trend, which was up to 4.4% against a 3% historical rate. But again, I think that is largely attributable to the fact that they're in recovery mode at the moment. But it'd be churlish just to dismiss it out of hand.
Sure. You say, just picking up on that, the new business rate before we go into some other details, I mean, Compass, as you expect, were quite bullish. They were saying, a lot of this revenue growth is coming from that increased volume rather than, just higher prices on the back of the inflationary pressures we all know about. It seems to me as well, they're obviously also making the case very much for, this outsourcing, companies outsourcing catering to them, the likelihood of that increasing further is growing, whether it be due to, everyone having supply chain issues, therefore using someone like Compass with their resources and their scale would make sense, or whether it be companies who now actually, want a bit more of an ad hoc service. They've got employees in the office on different days and they might not have the full catering facilities they once had. How do you sort of feel about that?
Well, certainly all those possibilities are genuine. It's conceivable that the business model will evolve in line with issues like hybrid working, for instance. But I think a business, given its scale, is always in a constant state of reform, really. And so I think, there's no doubt, I don't think it's just hype. This will only play out over time. I mean, you look at the scale of the operations as well. They operate in over 40 countries around the world and employ over 500,000 people. I think the salient point, or one of the salient points to come out of it as well, given the number of people that they employ, will be the impact of inflationary pressures going forward, but particularly wage inflation. But as you said before, the management were proactive in shoring up the cash position after the lockdown provisions were put in place by government. They raised about £2 billion and then also increased their credit facilities as well. So by the height of the pandemic, they had liquidity position of around about £5 billion, which allowed them to get through. I mean, there can't have been too many other sectors who had the rug pulled out from under them quite as quickly as hospitality, stroke food service.
Sure.
I guess another thing that caught my eye, the free cash flow, even though they'd had marked increase revenues and profits, they remained flat at around £360 million. But that was down to the fact that you had a working capital outflow, which was predictable given their costs associated with bringing capacity back online. CapEx was up as well, and the bosses flagged that that's going to go up through the second half too, and naturally they're paying more taxes too. I think, as I mentioned before, I don't think the company is necessarily out of the woods. It's a very positive turnaround for them as well. But we really don't know what impact rising soft commodity prices are going to have on earnings. And because it's a volume game with them, it's a volume game. Margins aren't particularly high compared to other sectors, and I don't think we'll really appreciate how bad the current food crisis is until next year, when you'll get major dearths in terms of cereal production and also edible oils too. We'll have to wait really to next year to just see the impact on the business there, in addition to wage inflation.
Yeah, there's definitely more cost pressures coming through. Using, I suppose, the anecdotal evidence of our own staff canteen, the some of those food costs, now they've reintroduced them, they've been going up, I think, about 50% this year, which is pretty high. But then they've held them down for a few years, and it's to be expected, I suppose. And I'm something of a captive customer myself, because I've continued to eat there, so maybe that's a good sign for Compass. Julian, what's your take on the company? Do you agree with Mark? Slightly equivocal, or
Yeah, I'm kind of slightly more skeptical about the future recovery of the company. I mean, the point that quite a few analysts have drawn out is that we won't actually know what the true comparatives are until next year. So there's a sort of a rebound effect that's come through from the end of the pandemic, and that might be feeding through into the sort of improved like-for-like numbers. So there is that thing to watch out for, that it might take 12 months actually to get a proper like-for-like annual comparison. The other thing was, I noticed that the CFO, the CEO noted that they'd improved their profitability by changing some of their menus. One of which was to swap trout for salmon, or salmon for trout rather. If only things in business were that easy. I think that's so. It's an interesting story, and I think it's a consistently good performer, Compass. You can't really take that away from them. But you do wonder whether there isn't a case that they're riding a bit of a tide at the moment, and how long that recovery continues is something of a question mark, I think.
It wasn't an even recovery across the group as well. Obviously, we pointed to the impact of hybrid working and changing employment patterns. It was perhaps significant that Tesco are trialing some flexible office space within their unused store space this week, which is quite an interesting development. But in terms of Compass, they saw good volume growth over in the United States, particularly within the division that serves the sporting market over there, and education as well, because obviously kids are returning to campus now. So, 7 out of 10 for the interim results. I think the market was very pleased by and large, and obviously the interim dividend and buyback helps to support the share price. But I would just warn on the impacts of inflation going forward.
I also noticed it's the first set of results where they haven't moaned about Brexit.
Yes.
Causing them an impossibility of recruiting staff. It's usually been the sort of the same thing for the last 5 or 6 years, but actually maybe they've now got enough staff, so that shouldn't be a problem.
Yeah, one thing I thought was quite interesting, more from a general economic point of view rather than for Compass's fortunes, was their comments about the office. The return to the office for their own business. They seem to think the business and industry segment can reach 100% of pre-COVID levels even without a full return to the office, because of things like companies providing more free food to their staff in an attempt to get them back, for example, which is perhaps slightly counterintuitive. But it was also interesting they were talking about actually that the tight labour markets are making that return to the office a bit harder. The implication being workers have a bit more leverage at the moment to say, no, I'd like to work from home for a bit longer if that's all right, thank you.
Well, that could change rather rapidly as well if interest rates keep on rising. Companies will be tightening budgets, and it'd be interesting to see the way it plays out.
Indeed, plenty of things still to be decided on that front. One other thing Compass mentioned, one way they are attempting to change their business a little bit is to reduce the amount of waste they produce from all their services, and that leads us neatly on to the cover story this week, also written by Mark, which is on the topic of waste management. Talking rubbish, all those kind of jokes will have been applied liberally around the office this week. But Mark, why don't you sort of take us through some of the topics you discussed there, because this is obviously not an area that gets people excited, but it's potentially one where there are some opportunities coming down the line.
Yeah, I guess if I could sum it up, the theme in one theme is that I think it's where regulatory edicts grind up against the reality. And here's an industry, for instance, that's in thrall to national and supranational regulators, and yet it finds itself also faced with dynamic change in emerging market economies as well. So just some of the points that I was making. The industry itself, just prior to the pandemic, is worth around about $1 trillion, and the growth rates. You obviously get variations in this, but it seemed the average growth rate that I was looking at seemed to be around about 6% per annum through to 2030. Some of that is down to increased regulations, increased strictures on existing legislation, but it's also down to the fact that middle classes are still expanding in emerging and frontier markets as well. There was also, in terms of Western recyclers, there was that a major impact a few years ago when China implemented its national sword policy. That was about 2018, which banned various forms of solid waste that Western economies had been just shipping over to China. And India and other Central Asian and Southeast Asian countries have followed suit as well. So we in the West are now left with a real problem, one that we've been effectively exporting. It's quite strange, really, when you look at the waste industry, given the fact that on the whole there are a lot of outdated ways of dealing with waste, not least of all digging a hole and just dumping it in there. But we've reached the point now, because of regulation and the fact that in the UK we're actually running out of viable landfill sites, that we're going to have to treat waste in different ways. And one of the underlying themes is that people are coming to realize the value of waste, or the potential value of waste. To just give you one example there, of course, we've seen an increase in the digitalized economy, and plus we have a mandated switch over to electric and hybrid motoring. But with that comes a lot of specialist waste problems, because of the heavy metals involved, and highly toxic, and we just don't have capacity to deal with that at the moment, nor does it seem the political will. At, just prior to the pandemic again as well, electric vehicles made up about 1% of the global stock and about 2.5% of new sales. Regardless of which way you look at it, if this is a mandated change through to 2035, it isn't just a case that manufacturers will be looking at ways of securing raw material sources, but it's also what happens with that waste once it's been used in batteries. This is where obviously recycling comes in, and the large recyclers could actually find themselves in another position whereby they become part of the supply chain. They already are to a certain degree, but it becomes an increasingly viable income stream for them too.
One of the things as well that you focus on is a method that again might seem somewhat old-fashioned, but to which people might be coming round, which is incineration and new advancements there. And one thing you also mentioned, you draw the comparison, I think, with the EU's recent move on natural gas rather, to say actually we will effectively accept this as a de facto green energy source because it's an important part of the transition. And something similar could potentially happen with incineration processes.
Well, I think there's signs that it already is happening. Obviously, in terms of natural gas and in fact nuclear as well, they're going to be reclassified as renewable sources of energy, which obviously ruffled some feathers in relation to this. But it's just that there seems to be no viable alternative for energy generation in Europe, because the intermittent nature of wind and solar, and the fact that it's just difficult to, whenever you build, evidence suggests that whenever you build renewable capacity into a grid, there's a commensurate increase in natural gas imports to cover the periods when the sun is shining and the wind ain't blowing. So with energy from waste technologies, and it isn't just a monolith, there are various technologies linked to this. It gets opposition, and has got opposition in the past because of pollution issues, particularly relating to the release of dioxins, which are extremely injurious to human health. Proponents of the schemes now say that the technology has moved on, and it's actually widely in use in Germany, and also the Benelux countries as well, as the technology has moved forward. So to give you some idea, the technology accounted for about 2.5% of UK power generation in 2020, but it's predicted that's going to hit 7 to 8% by 2030, which that's quite significant, really. And you look at the incineration of solid waste in the European Union. It more than doubled between 1995 and 2017. And I just think that we've got these increased volumes. We don't know what to do with landfill. Is not a environmentally friendly option, of course. I mean, there's sort of negative implications for the water table. So I really do think it's the case that no matter how good the regulatory framework is, how well intentioned, it just tends to sort of grind up against these meat hook realities. And I think that it's going to present a real opportunity for large waste management companies, because I think that that it's an industry as well that scale really matters. And I highlighted 3 companies within the article, but there are many others at play.
Thank you, Mark. Yeah, we have plenty of details on those companies and various others from around the world in the cover story this week. Veolia is quite interesting to residents of South London, such as myself, because during the pandemic, they're mainly known for the big reaction to the lack of daily, weekly bin collections, which, as we know, is a big perennial issue in local politics wherever you are. But maybe not operating so well on the ground in South London, but globally and as an investment opportunity is a different state of affairs.
I think we did point out as well that they, beyond waste management itself and power generation, and overlaps with other sectors, packaging being the obvious one, but that's another story.
We should get on to the big news of the week, markets-wise. In terms of the volatility, that is, what we've seen happening over the past few days. Coincidentally, I was just looking at the iShares Global Minimum Volatility ETF today, as you do, and the top holding there was the US company Waste Management Incorporated. So maybe there's another opportunity there in these difficult times. But that obviously Waste Management is very far removed from the action end of the market this week. Once again, we've seen some really sharp falls for tech, for speculative tech in particular. We'll come on to some of that in a moment, but we'll start perhaps from a funds angle. As John mentioned earlier, we have funds editor Dave Baxter with us this week. Dave, you have done a couple of pieces recently that have some relevance here. One from last week, a couple of weeks ago, talking about the lockdown winners, the funds that did particularly well during the pandemic, and your analysis kind of looked at actually how those returns are still holding up relatively well now. Obviously, we've had another week of steep falls for some of these funds in question, but maybe you'd just like to talk us through a little bit of those findings, those results.
Yeah, sure. So if we cast our minds briefly back to the earlier pandemic, we think of 2020, there was much of that discussion of lockdown winners, whether it's kind of tech or other trends, things like food delivery, all sorts of different things. And there were certain investment trusts in particular that really captured some or many of these trends. So you had various kind of Baillie Gifford trusts like Scottish Mortgage, Edinburgh Worldwide, Pacific Horizon in Asia, and then some other names like the Allianz Technology Trust, some of the China names, some biotech funds, that kind of thing. They all posted really stellar returns. Now, of course, if we fast forward to the current moment, as you mentioned, things have been really volatile in markets this week, but also in recent months. And they've all kind of struggled really extremely. I imagine if you're a shareholder in something like Scottish Mortgage, you may feel like the kind of world was falling apart. Scottish Mortgage actually slips this week from its position as the largest investment trust in the UK. But yeah, as you mentioned, what's interesting is this is very kind of hindsight blessed timing. But if you were to have invested a lump sum into any of these trusts at the start of 2020, if you look at them now, the vast majority, there are a couple of exceptions, but the vast majority are still sitting on gains. So names like, for example, Pacific Horizon is still on some pretty substantial gains. and most of them are still in the black. I just think that's perhaps interesting from maybe a psychological point of view as an investor. You're, like I said, it may feel currently like the world is falling apart for some of those more growthy and tech-focused funds, but actually, you're still kind of sitting on some wins, and maybe that influences your decision. Maybe it kind of reasserts your confidence in these holdings, or equally, maybe people will be tempted to sort of get out while they can if they still think things are, going to look pretty bad for the coming months or even longer.
Yeah, I think that is a good point. I mean, you relate it to the Nasdaq as well. You can do quite easily down another 10%. Just in the 5 working days since we last did the podcast, down about 30% this year. But really, that's only back to early or late 2020 levels. So there have been several years of gains, of course, prior to that as well. So it is important to keep these things in context. Speaking of which, the piece you've done this week has been looking at fund pairings. Obviously we've seen rotation from growth to value over the past few months. Growth is still selling off really sharply, as we say, particularly in the more speculative areas of the market. And you've been looking at combining funds in a portfolio to produce perhaps something a bit more balanced in terms of returns. Can you talk a bit about what you discovered there?
Yeah, so it's a bit of a thought experiment this. So with the renewed rotations, perhaps there's more of an emphasis on the idea of kind of pairing different investment styles, and whether you can kind of beat the market by doing so. So to go through it briefly, I looked at 4 distinct time periods where value has either performed well or has at least held up better than growth. So I looked at the second half of 2016. I looked at the sell-off in the final quarter of 2018. I looked at the sort of 6 months that began with so-called Vaccine Monday in November 2020. And then I've looked at the most recent kind of 6 months or so. And I just examined kind of globally in the UK and also in Europe, what would happen if you took sort of a stalwart growth fund and combined it with more of a kind of deep value fund in a 50-50 split in the portfolio. So on the global front, I looked at the flagship Fundsmith fund and paired that with Schroders Global Recovery Fund, which is pretty kind of deep value play, looked at some really beaten up stocks. And I suppose what's encouraging there is if you compare the performance of a portfolio split across those 2 funds versus something like the MSCI World Index, then actually over the first 3 time periods I've mentioned, that active combination does hold up better. So you are, particularly times when markets are rising, but it's being led by the kind of value ends, like for example, the 2016 period, then the value funds will really kind of shoot the lights out and lead things when the growth name is kind of struggling a bit more. And we kind of saw similar results in the UK and in Europe. For example, in the UK, we looked at pairing up Line Trust Special Situations with the Schroder Recovery Fund. I suppose one interesting and perhaps not very reassuring finding is, like I said, when markets are still rising, but things are getting a bit more cyclical, then these pairs work well. But the results are a bit less convincing when you look at times like the back end of 2018 or the last 6 months when value is holding up better, in some cases doing well, but still everything's struggling. So if we do see more investor panic, and I do wonder perhaps if we do see something like a recession, then perhaps simply pairing up value and growth isn't really going to kind of cut it. You're still going to take some pain, and so that's worth bearing in mind.
I think we've kind of seen, even in the past week, this rotation has been going on for a while, but in the past week, some of the comments we've seen from, venture capitalists, if you will, from the tech investors in the US, even the CEO of Uber, very much saying cash flows are king now. It's not about revenues, which is completely, the opposite of these several years we've had of stocks being analyzed and pumped up based on multiples of revenues. It seems there's been a bit of a eye-opening going on across the sector. I mean, Uber's CEO even said this week, I think we have to make sure our unit economics work before we go big, which really is the complete opposite to how companies like Uber get started. How you get a foothold and just try and grow until you finally reach profitability. So it does seem there is a real shift in thinking. Whether that lasts for as long as the market keeps falling or whether it continues remains to be seen. I suppose, Mark, from your point of view, we look at these kind of big falls. We see people talking about cash flows being king. That is kind of, to a lot of investors, that will be what they've always kind of thought. Part and parcel of doing your investment analysis. That's a mentality to which a lot of our readers subscribe, I think.
Yeah, I think what's happened over the last week just underlines the value of line-to-line investing, point-to-point investing, because it can be shown that value companies do well over time, regardless of volatility in the market, and I think it's just one of the fundamental aspects of investing as well. The trouble is now is that a lot of people will be casting around to try and find a safe haven in the market, buying into commodity-based stocks, and all that's fine. But if you've got a well-insulated portfolio to begin with, these periods of volatility are virtually sort of meaningless, really, if you take that long-term view.
Yeah, I think that's the key thing, isn't it? I mean, a lot of people, a lot of commentary does get wrapped up in the short term, and you've got to, as per the lockdown winners discussion, you've got to look back at the long-term performance.
Yeah, it's always. I mean, we have been here before. I mean, 20 years ago with the dot-com crash, it was exactly the same scenario, and I think that the red flag for any investor is always when someone comes up and says, "Well, this is a new paradigm."
Yes,
that's always for me. That's always a warning sign. Or they say, "Oh, profits don't matter," or any of, and they kind of get trotted out every 20 years because there's a new generation of investors and fund managers who will listen to the same story. But if you remember it the first time around.
Well, this time, possibly the worst, the most grotesque manifestation of it was a modern monetary, policy. The fact that you can keep on sort of running deficit economies indefinitely, and it was only a matter of time, really, before liquidity started to be withdrawn from the market. I mean, obviously what we've been going through since 2007, 2008 is unprecedented in terms of government intervention in the economy. But and in many senses, we've just been kicking the can down the road.
Yeah, I suppose the economic fallout is the next big question. We've been dealing with high prices. We have seen even US banks coming off the boil, quite a lot in the past few weeks, which does suggest, the recessionary concerns are starting to override the rising rate concerns. I know they combine together, but yeah, as you say, maybe some of those chickens are coming home to roost.
Yeah.
Yeah, I mean, the US is quite interesting because the banks that track the state of the underlying economy quite closely. I mean, the reason that's interesting in investment terms is because, unlike the UK, they don't form nearly as big a proportion of the overall US economy, but are still sort of vital to it. So it's a much more reliable tracker of activity. So I mean, that's definitely a point to make.
Yeah, I guess, as you say, it's always now more than ever a question of paying attention to the line by line analysis and looking to the long term, and trying to ride this out as best one can. That brings us to the end of this week's show. Thank you, everyone. Thank you to Mark and Julian and Dave for taking part, and thank you for listening. We'll be back again next week, hopefully with a little bit more of a relaxed week on the markets, and certainly with a lot more company analysis as well. So we'll see you then. Goodbye.
Companies and Markets Show was edited and produced by me, John Rogers. And don't forget, if you've liked what you've heard, please do head on over to iTunes, drop us a rating and a review. We'd love to get your feedback.